Hey, this is Ken Finnett at Capital Advantage Tutoring. It's my job to get you past the Series 7. So today we're going to talk about mortgage-backed securities. So let's have some fun. Okay, so let's say you're going to buy a house. So here we are, we're a little cute little house. Trust me, it's a Zoom house, so it can't be that good, right? And I have no artistic abilities at all. We're going to buy a house. So let's say in the good old long time ago, you could buy a house for 120 grand. So normally they would want you to put some money down. So let's say you put down, you deposit 20,000. That's your deposit. This is when you're buying a house, right? So now you put down a 20 grand. That means your mortgage is $100,000. Let's say it's 10%. And trust me, I'm making up numbers here. So there's 10% mortgage. So let's say that's going to work out to be where you're going to pay $1,000 a month. So you're going to pay $1,000 a month for 30 years. Pay $1,000 a month for 30 years. Now, remember, you're paying interest on this money and you're paying it back. So you put $1,000 a month for 30 years and then you've paid off the whole thing. In reality, if you think about it, you pay $1,000 a month for 30 years, you've actually paid probably $360,000, way more than you borrowed, but that's the cost of doing, the cost of leveraging and all that. But you do have a house to live in and whatever. Now, of that 1,000, each month, let's say the first month you pay your 1,000 and then $999 goes to interest. Okay. So we'll say $999 of that payment goes to your interest. And then $1 goes to pay off your principal. Okay. Then that's 1 month. Line here, block it out. Then the next month we pay another 1,000. So maybe then you pay 998.5 to interest. And then it's going to be $1.50. Just make it up numbers, just to understand. So there's an amortization schedule here that each month you pay, in the beginning, you're mostly paying interest and a little bit of principal. But every month it kind of flips. So at the end, near the end, like say 30 years from now, so we fast forward 30 years from now, that $1,000 payment, maybe 25, 30 years, it's going to be more like you're paying like, $4 in interest, and then 996 each month, 906 to your principal. Okay. So the whole point is that every month, 999 the first month, then 988.50 the next month, then 998 maybe. I'm just making up numbers again. And so it's always 1,000, but your interest is going to be paid out. A lot of the interest is paid off early on. And that's your amortization schedule. And that's the way it works. So in reality, in this case, you could pay, for a full year, 12,000, 1,000 a month for 12 months. It's 12 grand you've paid. You probably paid off maybe 15, 20 bucks of your mortgage. But I mean, every year it builds up. So in the 20, 30th year, in the last year, you're paying almost the entire mortgage payment is reducing your interest, is reducing your principal much quicker. So that's why a lot of people, what they'll do is they'll refinance. So they refinance they'll buy the mortgage and then they get out of it early. So when you hear me talk about prepayment risk and stuff, this is what I'm talking about. People are going to refinance because maybe they can get a lower rate or they can pay off some of the mortgage with, maybe they get a bonus and they want to pay off their mortgage. So because every time you lower if you can reduce the principal, your total interest costs go down, which is great. So that's this. You don't have to, this is not testable. Just understand the concept behind a mortgage. Now let's go a little deeper. Now this great old bank has this $100,000 mortgage. We'll call it Bank of America. Bank of America. Bank of America gave you the mortgage. They lent you the money. They're looking at an income stream of $1,000 a month for the next 30 years. Now, granted, they don't do one. They do hundreds of thousands of mortgages. So they have all this money coming in all the time. But they don't want to hold on to it. So after like 3 months, once you make your third payment, fourth payment, they sell the mortgage. So they'll sell it to someone else. We'll say, we'll just say for now, say Ginnie Mae will buy it. Okay. So Ginnie Mae will buy this thing for just as again, I'm throwing it out there, 120 grand. So the bank lends you 100 and then sells a loan to Ginnie Mae for 120,000 and the bank makes it quick 20 grand. Because they don't have the payments anymore. They flip the loan out to someone else who's a packager. We'll call that. Okay, now This $120,000, they paid for it. Now they don't buy one, they buy millions of dollars worth of mortgages. So we're going to do this. We're going to make a big pool of mortgages. So we have all these little mortgages in here. Boom, boom, boom. They buy tons of these. Okay. And usually they're same credit rating, same interest rate, stuff like that. It could be variable. So you have all these mortgages that Ginnie Mae's buying. Now remember what's coming in there. So as they're doing this, their people are paying their $1,000 a month or whatever it is. So they have money coming in every month. Everyone's paying their mortgages and the money goes in. Okay. I'm going to say okay a million times because there's no script on this script. Okay. See, like I said. So they're getting the money coming in. And let's just throw it out there. Say they buy $50 million worth of mortgages. $50 million, not 50 million mortgages, $50 million worth. So if it's 10%, that means every month there's $5 million coming in every month. And that's great. That's good for them. But that's not how they make their money. What they do is they find investors. So you're going to find investors to come in. And here's the thing. This is called the pass-through. So the money, what's going to happen is people pay their mortgages in here. So you have a bunch of people paying their mortgages. It goes in here, and then it passes through this and to the investor. So like boom, like that. Now, so let's talk about a company. So if you see the word PTC, that means pass-through certificate. That means it's usually a mortgage-backed security. So the pass-through certificate is going to go like this. You're going to invest $25,000. You're going to get monthly income. I'm going to make up a number. I'm going to say you're going to get $250 a month for 30 years. That's the thing. Every month you're going to get $250. Now remember, if you went over here, remember the amortization schedule. Some of your payment is principal, some interest. So in the beginning, I say out of this $250 you get, we'll say what you're receiving as an investor. Maybe in the beginning, it's going to be $249 of straight interest, and then $1 of principal, and then it'd be $248 and $2 all the way down. So understand you're buying this for 25 grand and you're getting paid for 30 years, but you're not getting a lump sum at the end. You're not. Understand how this works. You're buying into this and you're buying a little piece of each mortgage. Each mortgage, you're getting a little piece. So let's say you're getting 500 mortgages, you're getting 50 cents of, these people are paying $1,000 a month, say, you're getting 50 cents from this person, 50 from this, 50 from this, 500 times, which is $250 a month, and it's principal and interest. So each payment is going to be principal and interest. The interest portion is taxable. The principal portion is not taxable. So I hope we're okay with this so far, that you're investing 25 grand minimum. You're going to get paid $250 a month. You're not getting a lump sum at the end. You're getting paid back your money over time, the principal plus the interest. So you're not getting a lump sum at the end. It's not like a bond. So this is strictly for monthly income, not a lump sum. Now, if it is done by a Ginnie Mae, okay, so if it is done by Ginnie Mae, it's very safe because Ginnie Mae has strict rules. They can only buy mortgages that are backed by the government, whether it's Veterans Administration or FHA loans. Those are backed by the government, which means that the person who bought this house here, if they default, if it's eligible for Ginnie Mae, if they default, then they'll sell the house and they'll pay you. If there's not enough money to pay you, then the Ginnie Mae will step in and pay. Okay. And then this is why they call it modified, because it's multiple people backing it. And then if Ginnie Mae runs out of money, then the government will come and pay. So you're pretty much guaranteed to get your principal back, even if the person defaults. So this is great. You're getting the money every month. Now let's talk about this. You're getting monthly income. It's good. It's safe. It's a great little investment. Here are the risks. What if, now remember here, little Johnny over here had a 10% mortgage. What if interest rates drop to like in the economy where you can get a mortgage for 5%? Okay. Well, Johnny's not happy. He's going, wait a second, I'm paying 10. Why would I want to do that? So he looks, he says, oh, Wells Fargo is offering a 5% mortgage. So they will go to Wells Fargo and then refinance, which means Wells Fargo will pay off this loan. So they will get a new mortgage with Wells Fargo and pay 5%, say $500 a month, and they will pay off this loan. Boom, it's done. It's no longer anymore. So now this is with Wells Fargo, which is not part of this pool of mortgages. So technically, this pool of mortgages, maybe one of these just goes away. Boom, it's one less. So now what's the problem with that? So boom, he paid it off. It's with Wells Fargo. We now have 49.9, whatever you want to call, a lot less. This is paying less. So now also, instead of getting, I love when that happens. Instead of getting $250 a month, now you're only getting like say $245. because there's one less mortgage in there. Somebody paid, there's one less mortgage, and it doesn't just happen one time. It happens multiple times. People refinance all the time. So this pool of mortgages, there's no way it's going to last. This entire pool will last the entire 30 years. There's the people refinance all the time. It's like the American pastime. As interest rates go down, refinance, and that's fine. You should do that. Take advantage of lower rates. Why pay more than you should? But as an investor, refinancing is called prepayment risk. So if interest rates drop, you have prepayment risk. So that means you're getting less money each month. Now, what if interest rates go up to 15%? I'm not going to go through the whole math here, but what's going to happen? Little Johnny sure as hell is not going to refinance because he's very happy that they're paying 10% versus 15. So what's going to happen is nobody's going to refinance, and you're stuck in this because now you're earning 10%, and then your friend bought one of these things and is now getting like 15%. So they're making on the same investment $300 or $325 a month or $375 a month when you are making $250. So you're jealous. So you want to get out of it, but really, who's going to buy your 10% one when everyone else is getting 15%? So you'll have to sell it for a discount from what you paid for it. So then that's called extension risk because you're kind of stuck in the mortgage. So prepay and extension risk are real things. Now, to be fair, extension risk is, I call it jealousy risk. You're just jealous of the other person, like you're missing opportunity, whatever it is. But prepayment risk is an actual thing where you're going to make less money because remember, you're getting a little bit of a lump sum back of the print. You're getting a bigger principal check, but then you're supposed to reinvest it, but rates are lower. So you're going to earn less money. So it does hurt you. It actually makes you earn less money than you expect. Now that's a pass through. If it's Ginnie Mae, it's backed by the government. Fannie Mae can do the same thing. So Fannie Mae and Freddie Mac, they have very strict rules too, but they actually, Ginnie Mae can only buy government back. Fannie Mae, should make show respect. Fannie Mae and Freddie Mac, okay, we're just going to say Freddie, can buy more government, but they can also buy some private label. But they have very strict rules. It has to be high credit rating. I think it has to be under 700 grand. Again, not testable, but very safe. But Fannie and Freddie don't have government backing. So if the person fails on their mortgage, they will sell the house to better pay you. If they still owe you money, then Freddie or Fannie will pay out of their money to pay you. And if there's still not enough money, well, then you're out of luck. It doesn't have to be government. It could also be a private label. Private label is like a UBS, Deutsche Bank, Goldman, Bank of America doing their own packages and then selling it, but they can buy bigger mortgages, lower credit ratings, a little more nuanced stuff, a little crazier interest rates, credit ratings, whatever it is. So there's more risk, or maybe there's a higher rate. But the risk becomes if the person defaults, they sell the house. If they sell the house and there's not enough to pay you, you're out of luck. That's it. You're done. You lost your money. So there's risk here. So let's go on to the next thing called the CMO. So the CMO, what they did was, let's get rid of the house here because it's not as big a deal anymore. Buy house, buy Johnny. Okay, so now we'll get rid of the pass-through certificates. So what happens is instead of them selling to an individual investors, they will have like one company come in and buy all of the mortgages in one shot. Boom. But here's the magic of this. So what they do is they figured out, Merrill Lynch, I think, was a leader in this. They figured out 50 years ago that they can actually take advantage of this. Remember, if you buy a mortgage-backed security, you have prepay and extension risk. You're buying a 30-year product, but there's a really good chance that you're going to have to, you're going to get prepaid a lot, refinanced. Even if one person refinances, you're getting less money. Keep that in mind. Even one person refinances. So they would buy this thing and they would do PSA with prepaid speed assumption. Okay. So that's what they're trying to figure out, how fast people will prepay based on current economics, the mortgages, all that stuff. So they do this and then they sell it tailored to those kind of people. Now I'll explain it. So let's get this out of here just to make it not so confusing. Boom. So we have a CMO, which means that we have our little pool of mortgages. We'll say it's $50 million that Merrill Lynch bought. We'll say 50 million. And they say, oh, according to under the PSA rules, we think that 10% of these mortgages, we don't know which people, but we think 10% will refinance in the first 1 to 3 years. Okay. So the 10%, so that's $5 million, because it's 10% of 50. Okay. So we think $5 million worth of these will refinance in the first 1 to 3 years. And then we think maybe 5%. Wow, that's horrible. We think 5% will refinance, which 5% is 2.5 million, right? 2.5 mil will refinance between 4 and 6 years. And then we'll say maybe just based on weird things, we say 10% will refinance in this thing. So it's another 5 million. And remember, I'm making numbers up just to make it, for example, between 7 and 10 years. So what they're going to do is they're going to sell. So that means $5 million worth of mortgages should refinance in the first 1 to 3 years. $2.5 million, which should finance in 4 to 6, and then 5 million should in 7 to 10. Again, 7 to 10 years. Again, guessing, it's all algorithmic. It's not like there's not a hard rule on this. So what happens is they will sell $5 million worth of 1 to 3 year CMOs. We'll call that tranche. Give it capital, give it some respect. Tranche, French for slice, tranche A. So tranche A, anyone who buys a tranche A is buying a 1 to 3 year product, average. Remember, they can't guarantee it. It's average. They're just guessing. Okay. So you buy a 1 to 3 year CMO. That's paid. Now it's likely to pay back in 1 to 3 years. So you sell that to people who want their money back in 1 to 3 years. So you're going to sell $5 million worth of tranche A. And then here you're going to sell this. The second one is tranche B. And again, there's no guarantee of anything. You could all get nailed in the first year, not have anything happen for 10 years, whatever. And we'll call it tranche C. They go all the way out to tranche Z, which is like a 0 coupon, and it's all for late payments and people who the last thing's paid. So now, every one of these tranches is getting paid. Where's my good old arrow? Every one of these tranches is getting paid every month. They're getting monthly payments. We got that. That's called pro rata. Everyone's getting paid. Now, granted, tranche A, since it's a shorter term, will get a lower return. B longer. B will be a higher return. C would even be a higher return than that, but not by much. Because most of these CMOs, unless they say otherwise, are derivatives, and they are a derivative of Ginnie Mae mortgage-backed securities, okay, of the past certificates. So what don't they have? They do not have a lot of default risk or very any, because the government will pay off the mortgage. So now we're back to this tranche A. So as people refinance, so the first $5 million worth of mortgages to refinance pay off tranche A first. Okay, so think about that. The first $5 million of mortgages will pay off tranche A first. And you think, okay, that sucks. But no, because that's who they sold it to, people who wanted the money back in 3 years. Maybe they have a 15-year-old. Maybe they have 3 years or saving money for, whatever it is. You don't really want to target because you don't know when, but I'm just using ballpark. They have a much shorter time span. So remember, in the old Ginnie Mae, even if one person refinance, you're getting less money. Here, tranche B and C don't even see a difference until after the first, once the first 5 million is done, then it starts. So here, $5 million. Why can't I drag it? Because I'm an idiot. I'm going to leave it. I'll just send it this way. So $5 million, they pay off that way. And then once everything in tranche A is gone and paid off, then B starts getting paid off. Then once everything B is gone, and then C starts getting paid off. So what happens is tranche B, you're saying 4 to 6. It's likely that you're going to get paid off in 4 to 6 years. There's no guarantee of anything, but you won't get any prepayment risk until everyone in tranche A is gone. So that's great. So even the first $5 million worth of mortgages pays off, tranche B and C are not affected. Once you're at 7.5 paid off, then C starts getting affected. So what happens is they're paid pro rata, but they're paid off in order: tranche A, then B, then C, then D, then E, all the way out. So if you want, not to get paid early, you buy one of the later tranches. Again, no guarantee, because you could have a crazy event and a bunch of people get paid off in the first year. Now, let's say 8 million gets paid off in the first year, just like a freaky event. It still will go tranche A first, then tranche B, and then tranche C. So again, CMOs, they get paid pro rata. Everyone gets monthly payments, but as they pay off, they pay in tranche order. So this way, the people in B and C, you're limiting your prepayment and extension risk. You're doing that. That's awesome. But you still have some, okay? So they're going to talk about another thing. So I hope we're okay with this. If not, replay it and then jump on my live if you need a better explanation. So we have what we call here a plain vanilla CMO. Plain vanilla just means, boom, we have some extension risk, we have some prepayment risk, but as I explained before, not a lot, because you're kind of working it through on that. You're using the algorithms to get stuff, but you do have some. So what they do is they created another thing, which they added like other types of loans to add to your CMO to take on some of the prepayment risk. So instead of having, so these are other type of mortgages that you do not have to worry about. Okay. Don't worry about the interest only or principal only. Just know that these things are called companion classes or companion tranches. Okay. So they're attached to a CMO to, again, even reduce your risk even more. So like this one will reduce prepayment risk. This one will reduce extension risk. So this whole thing right there, that package right there is called a PAC, P-A-C, Planned Amortization Class. Planned Amortization Class. It protects against both prepay and extension risk. Boom. It's the safest of them all, or the most likely to be paid on a consistent basis, but it's also going to have a lowest return because remember, less risk, less pay, more risk, more pay. Then we have another type called a TAC. A TAC, I'll erase the whole thing to make it easier. A TAC, a targeted amortization class, targeted amortization class. Can I spell? I don't think I can. CAS, who's CAS? But what they don't have is this. There's no protection against extension risk, which who really cares? Extension risk, again, like I said, is jealousy. You're just jealous other people are making money. So this is a targeted. So targeted protects only against prepay risk. Planned protects against both. Targeted only protects against prepayment risk. Know that you can't compare them to other products. You can't compare a CMO to a bond because it's not. Think bonds, you lend money and you get paid interest and then you get a lump sum at the end. CMOs and pass-through certificates or asset-backed securities, you're getting paid every month, but then you're not getting a lump sum because you're getting paid back some of your principal every month. The other part of this is there's a separate thing called the CDO. It's basically the same thing that they do. They package the loans, they buy pieces of it, but they're like credit cards, school loans, car loans, stuff like that. So they're riskier because there's not a strong, like a house asset behind it. Even though mortgages seem like they have, everyone talks about high default risk. There isn't a lot because mortgage companies are pretty tight with what they do. And they used to not be as tight, but even then mortgage default rates are significantly lower than everyone would think they are. So pretty safe. Anyway, hope that helps. That's CMOs and Ginny Mays. Please like, subscribe, share.